Good morning and welcome to the third day of International Treasury Week. The last couple of days we've been focusing on managing the fallout from recent events, and the plan is for the next couple of days we're beginning to look at wider issues that remain on the Treasurer's agenda. And today we're going to start by looking at arguably one of the biggest challenges facing Treasurers, LIBOR transition. Before we get going, here's some housekeeping. Please submit questions via the Q&A button, which is generally above our pictures on the screen, and we'll do our best to take questions as we go along. So please do ask as they occur to you. All questions are kept anonymous, so please don't worry about what you're asking. This session is being recorded and the proceedings will be made available for rewatch on the event portal shortly after the session ends. There's a virtual discussion forum which allows you to share your comments, ideas and references about the session with speakers and fellow attendees. And finally, do get engaged with the ACT on social media. There's a LinkedIn group, follow us on Twitter at ACT Update, and tweet using hashtag ACTITW. Next, let me make some very brief introductions. For those of you who don't know me, I'm Sarah Boyce, and after many years of working in corporate treasury, I now work in the policy and technical team here at the ACT. Today, I'm delighted to welcome a number of true experts in the field of LIBOR transition. Firstly, Edwin Schooling Latter, who is Director of Markets and Wholesale Policy at the Financial Conduct Authority. David McNally is IBOR Transition Director at Corporate Banking for Deutsche Bank. Olivier Gayno joins us from HSBC Global Asset Management in France, where he is the CIO of Wealth and EMEA Liquidity. And finally, but by no means least, Jamieson is Head of Syndicated Loans Agency and LIBOR Transition at NatWest. You don't need me to tell you that the demise of LIBOR is going to have a potentially enormous impact on all firms, not least because LIBOR is endemic throughout the organisation. In the move towards alternate reference rates, treasurers need to understand how markets are developing, not only in the various financial markets, but also across jurisdictions, so that they can develop solutions that are appropriate to their own organisation. Simply put, giving you an update on the latest developments in LIBOR transition is the purpose of this session. Anyway, that's more than enough from me, as it's our guest today that you'll definitely want to hear from. So, Edwin, perhaps I could ask you to start off by providing us with an update from the regulatory perspective.
Thank you very much, Sarah, and it's a pleasure to be with you all this morning, at least virtually. I should apologise in advance if some of the hazards of interruption from 1- and 4-year-olds, or even a cat's tail crossing my lap between me and the screen, occurs during the course of these remarks. But fingers crossed, that won't be too severe an occurrence if it happens. It's a real pleasure to talk with you all about this subject. And I thought I might just begin, although it may seem obvious, with why this is something that's so high on the FCA's agenda. Now, partly that is, of course, because the FCA is the regulator and supervisor of benchmarks, financial benchmarks, including LIBOR. Also, of course, as the C in that corporate name indicates, we are the conduct regulator. So how banks treat their customers is the raison d'etre of the FCA as an organisation. And in this transition from LIBOR to more robust benchmarks, ensuring that all parties can be confident that the end result of this transition is a benefit to them, and that all are confident that they have been treated fairly, is a central focus of the work that we have been doing as an authority, but also a central focus of the work of the risk-free rate working group, which is the combined body across private sector with the authority's support that has been leading the transition effort in the UK. And the ACT, our host for today, are a very active member of that group, and so of course are the lending banks, some of whom have representatives also on the panel here today. In these remarks, I'm going to run through some of the when, why, what and how questions of the transition. And I hope that those will be reasonably clear, but of course I'm very happy to take questions from participants later on in the session. Let me start with the when, and I do that to impress upon you all, if you're not already aware, that this is a near-term and becoming an urgent issue on which to focus. So the FCA announced back in summer 2017 that we had brokered an agreement with the 20 panel banks that combined to form the LIBOR interest rate benchmarks, that they would continue to do that until the end of 2021 in order to provide a solid, stable 4.5-year period in which transition away from LIBOR could take place. And now, of course, we're more than halfway through that period, and we have a little over a year and a half to go until the end of 2021, by which time everybody needs to be ready for life without LIBOR. And as Sarah has said, that is a big change. LIBOR has been deeply embedded in our financial system across a whole range of financial products, in people's treasury and other systems. So there's definitely a significant amount of work that has had to be done and that will have to be done in the remaining period before end 2021. I will come back to the when point later in these remarks, but let me turn to why are we doing this? And I think there are two main sets of reasons for that. And one of those reasons is that the market that LIBOR used to measure, so the unsecured term interbank lending and borrowing market, just doesn't exist in the way that it did through the 1980s, 1990s, and the beginning of the 2000s. That changed probably irrevocably after the financial crisis, when banks moved away from term unsecured interbank funding as a source of funding their own operations, because of course it doesn't have the stability that the financial system needs. And if you have the time and energy to go over some of the previous FCA speeches about the rationale for the transition, you can see some really striking figures in that. So, for example, in one of the LIBOR currency tenor rates, actually over an entire year of producing that rate, there were only 15 transactions of the relevant currency and tenor conducted by the whole set of banks in that currency panel. Now, that's obviously an extreme example, but it underlines a point that is actually true across all the LIBOR currency and tenors, with the exception of the overnight tenor, which is that this is not the way that banks fund themselves anymore. Now, I can hear a little bit of the one-year-old noise in the background here, at least. I hope that's not coming over too loudly on your side, because I want to turn to the second reason why we think moving away from LIBOR, notwithstanding the costs and inconvenience that any transition of this type incurs, is that we don't think the LIBOR benchmark is actually the sort of interest rate benchmark that most users want to have. Now, that is very evident in large parts of the interest rate derivative market, where generally participants in that market are trying to hedge the general level of central bank policy rates, so risk-free rates, rather than trying to hedge bank credit risk. And as most of you will be aware, LIBOR is actually a combination of those two things. So it's both an expectation, embeds an expectation of what central bank policy rates will be, and an element of bank credit risk reflecting that term unsecured element in the market that LIBOR used to measure. Now, I think that is also true for most borrowers. And here, obviously, I think is the point that will speak most loudly to the corporate community, is that when you're a non-financial corporate borrowing on an interest rate, why would you really want your interest payments to go up at a time when the banking system was under stress? Because that's what happens with LIBOR. And if you go back to the 2008 financial crisis, yes, those of you who experienced that in your respective treasuries will have seen LIBOR rates overall coming down. But that reflected the very significant fall in central bank policy rates, whereas actually the credit spread element in LIBOR went up. And now, of course, we're in a different world from that in 2008, where policy rates by central banks are already much closer to the zero lower bound, to the extent that is a lower bound. And I think if you look at the behavior of LIBOR over the past few weeks, you can see another graphic illustration of how its behavior differs from a risk-free rate. So in the midst of this crisis, the central bank here in the UK, Bank of England, but also in the United States, that the Federal Reserve, both of them acted very quickly and decisively to reduce their policy rates to 0.1 and to a target range of around 0.25 in the United States. And those borrowers who had already transitioned to SONIA, which I shall talk a bit more about in due course, which is the preferred successor rate in the United Kingdom, or to SOFR, secured overnight financing rate, which is the preferred successor in the United States, will have received the full benefit of those central bank actions in terms of the interest rates that they have been paying since those moves. However, if you are still borrowing on a LIBOR interest rate, actually about 2/3 of that central bank relief will have been offset by the increase in the credit spread element of LIBOR. And that's true both in the UK and in the US on the most commonly used LIBOR tenors. Now, obviously, the precise amount varies depending on which rate you're looking at and on which day. And it's true to say that those credit spreads have begun to come back in again. But I think it's reasonable to conclude that the events of the past couple of months in terms of the impact of coronavirus reinforce both the logics for the move away from LIBOR. So on the one hand, we saw that market that LIBOR seeks to measure, term unsecured interbank borrowing, pretty much dried up entirely in the week of 16th of March, which was the one when markets were most severely stressed as the news of the scale of the virus impact became clear, but also in terms of looking at the way that LIBOR has behaved compared with risk-free rates. Now, let me go briefly to the where we're going. So we're moving away from LIBOR, but what's the successor world? And I think as nearly all of you will know already, there is a range of overnight near risk-free rates that has been selected by market-led groups in each of the 5 LIBOR currency jurisdictions. UK, US, Euro area, Japan and Switzerland, and their respective rates. SONIA in the UK, SOFR in the US, I've mentioned both of those already, but ESTR in the Euro area, SARON in Switzerland, and TONA in Japan. So a common direction across all those jurisdictions towards overnight risk-free rates. Now, while it is true that some of those rates, so SARON and SOFR in particular, are secured overnight rates, so collateralized lending, and SONIA and TONA, for example, are not, I think that's exaggerating the difference between them, because on an overnight loan, both of those are effectively risk-free rates. So I would say there's a common direction across the globe in terms of what will be the future center of gravity of interest rate markets. Now, clearly those are overnight rates, whereas the main, most commonly used LIBOR rates have been term rates. So 3-month or 6-month LIBOR look at the expectations of central bank rates over the 3 or 6 months to come, and that's different from an overnight rate. And that throws up some transition issues about how you move from forward-looking term interest rates to overnight rates. And if you're borrowing over a term, which of course you normally will be doing, let's say a 3, 6, 12-month term, how do you, what point do you poll the interest rate that you're going to pay? Do you do that at the beginning of the interest period or at the end of the interest period? And that's been one of the transition challenges, in the sense that that can be quite a significant change in practice. Now, let me come back at this point to the when questions in terms of what the transition timeline looks like. And here it's worth pointing out that, of course, we are speaking more than midway through this journey. But the journey has progressed at different speeds in different markets. So if we were looking at the bond market, for example, so floating rate bonds, actually, transition there is essentially complete. So it's been, certainly in sterling, so it's been quite a long time since there was a public offer of a sterling floating rate note which referenced LIBOR rather than SONIA. And that's for understandable reasons, because the participants in that market are well aware of the limited lifespan of LIBOR. And the logic that I set out earlier is actually, why would the issuer of a bond want to have the uncertainty of their coupon payments being linked to bank credit quality and how that moves? There's no good rationale for doing that. So on the bond side, the transition has essentially completed in terms of new business, at least. And indeed, even in terms of outstanding business, some of you may have tracked the news of the conversion of quite a significant number now of outstanding LIBOR referencing floating rate notes to refer to SONIA instead. In the securitization market, similarly, although a little bit behind on the bond side, because of course there's a more complex interrelationship between the security and the assets that underlie it. But most new securitizations for some time in sterling markets have been SONIA rather than LIBOR linked. In the derivative markets, the swaps market had a bit of a head start because SONIA swaps were already reasonably well used, particularly at the short end of the curve. And if you look at the latest data that comes in from regulated firms, so available to the FCA, for example, in the first quarter of this year, 2/3 of new sterling interest rate swaps actually referenced SONIA rather than LIBOR. That's particularly at the shorter end of the curve, SONIA very, very dominant. But even at the longer end of that curve, where SONIA was not previously used, we now see that it's a significant part of the market for new sterling interest rate swaps. And that then brings me onto loans, which I imagine will be the main theme of our discussion today. And that is the market in which transition has been slowest so far. Now, I don't think that that's accidental. It obviously is a market which brings in a much wider range of counterparties than some of the others. It's one where there's a greater amount of training that lending banks need to do across their relationship managers. And it's also, of course, the loan market is the one for which LIBOR was actually designed back in the 1980s. So I don't think it's entirely surprising that loans are a little bit behind. But some of the logic for moving away from LIBOR is just as powerful as it, if not more powerful, in the loan market as in the others. Now, because the loan market has been the slowest to proceed with transition, it's also the area where the virus itself has had the biggest impact on the transition plans that we had set out in the risk-free rate working group. So actually, we had a plan to stop all new LIBOR referencing sterling lending by the end of the third quarter of this year. And we were reasonably optimistic that at least across the main lenders and across most lending relationships, that would be achievable. However, the virus has changed that, and I think all parties recognise that in the midst of this pandemic, the priority on all sides, official sector, lending banks and borrowers, has been to keep credit flowing to the real economy. And recognising that in many borrowing institutions, as well as in the lenders themselves, resource was just diverted for understandable reasons to keeping those critical systems going. We have relaxed that timetable for ending LIBOR referencing loans in sterling markets. Now, the new date for such lending to cease is the end of Q1 2021. However, in deference to the earlier target and the reasons for it, there is still an expectation that lenders will offer borrowers a non-LIBOR alternative in all new lending from the end of the third quarter this year. So it will really be only where the borrower itself does not feel ready to move to an alternative that LIBOR referencing sterling loans will continue. Now, even where that is the case, recognising that sterling LIBOR potentially will only have a 15-month and shrinking lifespan left, those new lending agreements struck after the end of the third quarter this year will also be expected to have an explicit arrangement for moving away from LIBOR before the end of that period. And by that, we mean more than a passive fallback, which is activated if LIBOR stops, but actually a pre-arranged plan to convert it to SONIA or another alternative, bank rate, or indeed to renegotiate that facility before the end of that period. And that's to reduce the prospect of a lot of borrowers being taken by surprise at the end of 2021 when sterling LIBOR could well cease. Now, I'll talk briefly about some of the other currencies and then, in the interests of time, hand over to others and to questions. But important to stress that this isn't just a sterling issue, and I understand there's quite a lot of international firms on the call as well. And I referred earlier to the various new risk-free rate alternatives to LIBOR that have been selected in other jurisdictions. Now, there's a lot of coordination that goes on between the authorities here and in the US and Japan and Switzerland and the Euro area on this transition. And indeed, you will sometimes hear reference to a body called the Financial Stability Board and its Official Sector Steering Group, or OSSG. That's quite a set of acronyms there. But that's the international forum through which authorities have been coordinating this transition. And I think it's fair to say, perhaps unsurprisingly, because we're a relatively small market, that in some of those other markets, transition, whilst on a similar path, is not yet as progressed as it is in sterling. Nevertheless, the direction is the same. And you'll see, albeit not at the same levels yet as in SONIA, you'll see increasing liquidity in SOFR derivative markets in the US, starting from a low base compared with where we started in the UK. You'll see more SOFR referencing bonds in the US, and so on. Now, I was invited to speak to about 15, 20 minutes, and I'm in danger, Sarah, of going beyond that. So why don't I pause there, and we can see where the rest of the discussion takes us.
Thank you very much, Edwin. Actually, I think the rest of us were thinking perhaps we could just sit here very quietly for the next 90 minutes and leave you to it. The equivalent of going down the pub. But thank you. That was really helpful. And I think certainly the why and the when is very clear. I'm now going to broaden the conversation for the rest of the panel so that we can start to explore a number of the topics that Edwin's touched on. Perhaps we could start with brief introductions, including how you've been involved in the LIBOR transitions. Jamie, would you like to go first and just introduce yourself and explain sort of your involvement?
Sure, thank you, Sarah. So I run the Syndicated Loans Agency team at NatWest, and for the last 12 months or so, I've also been our business LIBOR transition lead. So it is my kind of responsibility to design, set and implement the strategy for NatWest Commercial Bank to design an appropriate go-forward set of products and to work with our bankers and client base in order to help transition our existing LIBOR book. I also chair the Loan Enablers Task Force, which is a body that has been kind of devolved from the RFR working group, where the specific aim of that group, or the exam question there, is how do we get a greater volume of cash loans going on in the UK market. So there are, David is on that group with me, and it's a group that made up of probably about 12 lenders, a number of corporates, and some sort of legal representation as well. So that's my involvement in LIBOR transition at this point.
Thanks. I'm pretty sure we'll be back to you on the loan enablers any minute now. Olivier, would you like to explain your involvement?
Sure. So within the asset management subsidiary of the HSBC group, I'm running the European money market funds, which is mostly sterling and euro, as you can imagine. And obviously, as a big user of LIBOR reference securities, I've been involved into the LIBOR working group within the asset management side in order to manage our transition both into new investments and the legacy book that we have in our funds.
Super, thank you. David?
Hello, everyone. So I took the responsibility and have the privilege of leading Deutsche's corporate banking business through LIBOR transition. And that is a global project. The group overall has dedicated a significant amount of resources to this topic. And just by way of background, prior to that, I came from the capital markets side of the business, and I spent 3 or 4 years over in the United States on Wall Street. And Jamie's already mentioned that I have been involved in the Loan Enablers Task Force, and I think we'll probably spend a bit of time today talking about the more, I hope we will, the more practical aspects of getting this done, which is what a lot of the dialogue in that group and many others that we participate in have focused on.
That's great. As you know, I'm a big fan of the practical aspects. Thank you very much indeed. So before we talk about what corporates should be doing, though, perhaps we can unpick a little bit more about what's happening in the wider financial markets and what the banks have been doing, sort of effectively a little bit more about where the markets are now and progress to date. Shall we start with the derivatives market? Because my intuition tells me that's by far the most developed, established market. David, would you like to talk a little bit about maybe things like where the derivatives market is, what's going on with ISDA, she says vaguely.
Certainly. So Edwin's kindly already sort of set out a lot of the backdrop to this, so I won't repeat much or any of that. But I'll start by saying it's clear that this is a market a market structure change led by market participants. Is not being explicitly legislated for. And so that means that parties to legacy contracts will need to amend them. Practically speaking, that means one of two things for market participants. The interest provisions in agreements need to be amended directly, or indeed existing fallback provisions which contemplate a method for calculating interest if and when LIBOR is unavailable, may be amended to provide for the transition to these risk-free rates that we've been talking about, on or indeed before LIBOR's permanent cessation. So in derivatives markets, ISDA favours the latter approach, so the fallback approach, if you like. And to your question, Sarah, we anticipate them publishing a protocol to the ISDA master agreement, which parties can choose to apply to their legacy contracts. And now this is as a result, without going through the whole potted history, of a consultation with the aim of designing a fallback that would apply to all LIBOR-linked derivatives across regions and across different markets where LIBOR and when, LIBOR is discontinued. So since being published back in, I think it was the summer of 2018, that consultation and follow-on consultations and its outcomes have already actually, funnily enough, impacted the LIBOR RFR basis. And we've already heard from Edwin in currencies such as sterling has already prompted the initiation of transition activity. And as Edwin has already alluded to, it's absolutely the case that the sterling market is the most advanced in that regard. So again, back to the practice, the implementation initially for this through new trades will be a change in the ISDA definitions. And then for existing contracts, as I've mentioned, an amendment to the protocol will be made available, and that is a choice for market participants to enter into and adopt the protocol, such that a fallback provision will apply to legacy trades. But that will only be the case where counterparties have both signed up to the protocol. So that's a little bit about the documentation approach, if you like. Let me just make a couple of other comments, if I may, about market activity and liquidity, just to follow on again from what Edwin has said. We've already heard from him that the transition for derivatives and bond markets is well underway, with the sterling market leading the charge. The SONIA derivatives market is now very liquid, and catching up, and in some cases overtaking the sterling LIBOR market, making it the most advanced in the transition across the major currencies. Now, our clients at Deutsche Bank have actually been actively looking to us for solutions to remove their LIBOR exposure for some time as the industry transitions to new risk-free rates. And we and many other participants have completed a number of trades linked to the new benchmarks. Just an observation, I don't want to polarize this into the sterling market, but the volumes of SOFR derivatives are increasing, but do still remain well under dollar LIBOR volumes and indeed number of transactions and notionals. And there are only a few derivatives that are referencing the European ester since its launch in October last year. I hope that's helpful. If you want, I can just add a couple of other thoughts just on, again, the practical elements of transition considerations, just to pick up where we were.
No, I think that would be really helpful. But before you do that, I just had a quick question about the counterparties that you're seeing in the derivatives market. Are those largely still interbank, or is it a more diverse group of derivatives traders there now?
So in the more recent past, we have begun to initiate contact with corporates. But the majority of flows, I would say, for the transition flows, have been bank to financial institutions, big clients.
Yeah, that's just helpful to understand. Thanks.
It's fair to say that now time is of the essence, and we are beginning to encourage the universe of all of our clients to think about this topic very seriously.
Thank you. Sorry, carry on.
That actually quite nicely comes on to the other comment that I was going to make for the audience here, is to talk very, very high level about those possible transition routes. And my comments now I will reflect on the derivatives market, because I know we're going to pick up on the cash markets in just a minute. So in essence, there are three at high level possible transition routes. One, do nothing. And of course, if you do nothing, you are open to the greatest amount of legal, economic, and potentially other unquantifiable and operational risks. And needless to say, that is not a path that I personally would recommend. I think the takeaway from today is, don't be complacent. You really need to think about this now. Two, you can sign the ISDA protocol when it's available, which is, I guess, at an operational level, it's a minimal effort and relatively low cost. But that does come with a couple of other considerations. And without getting too technical at this point, it does mean that you don't know when you will lock in the LIBOR risk-free rate basis. Hence, you do have a small degree of economic risk. The third option is to be even more proactive, and that is to look at your portfolio and consider restructuring and/or some sort of basis overlay strategy. There are much more complex execution and overheads all around in this, but it does mean that any restructuring may technically lead to traded levels, which may retrospectively end up being worse than what ends up in the ISDA fallback level. So there's a trade-off here, but again, of the three options, 2 and 3 clearly present the more proactive approach, and certainly the residual risk in either of those is degree lower.
Thank you very much indeed. That's really helpful and very clear. Olivier, perhaps you could give us a little bit of an update about what's been going on in the asset management money market fund world when it comes to IBOR transition.
Sure, Sarah. So what we've been doing first, and we've been doing this relatively recently, is first to change the benchmarks of our liquidity funds, the money market funds that we're managing towards nearly risk-free rates. And that's the first of the three topics that I would cover on asset management. So why have we done this? Obviously, we are shifting from LIBOR reference to risk-free rates as anybody, whether it's SONIA, SOFR, or ester into our funds. But I believe also it has a value because I would say the natural alternative for a money market fund's investment from a treasurer is a bank deposit. It's obviously very different products, but it's a kind of alternative there. And in this sense, these rates, whether they are SONIA or ester or SOFR, actually a good representation of what the treasurers could get as a remuneration from rolling an overnight bank deposit or an overnight repo with banks. So in that sense, I think this move has been welcome, and I would expect that my colleagues in our other houses will follow up or have done so already. So that's the first thing that we've done around this transition. The second is more on the asset side of the funds, and what we've seen here is that into the money market instrument space, we are seeing issuance increase into this new benchmark, especially in SONIA and SOFR. However, they are still a little bit less liquid than the dollar LIBOR or the sterling LIBOR money market instrument issuance. So we have to have a trade-off between going into these new securities and going into something that is a bit less liquid. Now, going into these securities from our point of view is actually a much better trade-off than going into LIBOR index securities for a reason that Edwin went into, which is that these risk-free rates are actually really a good reflection of a pure interest rate hedge, rather than to have a LIBOR, which is a mix of credit spread and interest rate duration risk, which is very often difficult to separate. So going into an investment linked to SONIA or to ESTA or to SOFR is actually much pure in terms of hedging the interest rate risk and knowing exactly the amount of credit risk you are taking for the issuer and the maturity. And the third point, obviously, is to manage the existing back book and look at our what we have in the portfolio and trying to transition. And there, really, in terms of the bond side, it's more one-to-one. It's a bit slow. It's a bit behind derivatives, and we are really making our headway into trying to get some contacts there and trying to manage how these things will evolve, and especially look at these famous fallback clauses, what happens if the documentation is right, and so on and so on. So that's really the three panels we are looking at from the asset management point of view. And it's not only the money market funds industry, as Edwin was saying, for example, in the sterling ABS market, now there's a massive issuance into a link to SONIA and shifting away from LIBOR to SONIA. And again, it's been a bit slower in other segments of the market, but we are going there, and it's work in progress.
Thank you, Olivier. And I think that's really helpful because there are lots of lessons that can be learned there as corporates are moving into their own transition. Now, Jamie, perhaps we could talk a little bit about the cash market more generally, and perhaps specifically we could start with loans and bonds. Could you give us a bit of an update as to where we are in those markets? And also a question that has already been asked is that they seem to be moving slightly differently, the loan market and the bond market. Perhaps you could address that point as well.
Yeah, of course. So I think I'll kind of take that in order of which my knowledge increases. So if I start with the bond market, I think Edwin and others have already articulated that is perhaps the most mature of the markets if we look across the three sort of product sets, if you like. In my view, that is largely driven by the participants within that market and the nature of the instrument that they are that they're writing, and it lends itself quite nicely to an overnight rate. When you move then forward into the ISDA market, again, I think by new issuance we're seeing that inflection point of new swaps outnumbering new swaps against SONIA, outnumbering those on LIBOR. And then it all seems to get to a bit of a juddering halt when you get to the loans market. I think that the principal reason for that is that in the loan market you don't enjoy some of those other other features of the other two markets that we've just talked about. So you have a tremendously broad set of market participants. You have an incredibly flexible product offering that is tailored by and large to meet the exact demands of what it is that borrower wants to achieve. And fundamentally, and arguably most importantly, it is a private market. So where the loan market struggles, I suppose, is it doesn't operate in the same way as an ISDA governed ISDA protocol, whereby we have a sort of an overriding body that sets the new set of rules or criteria or expectations, and you either choose to sign up to that or not. What you find in the cash market is that we sort of have to find our own way there, and trust that we all arrive in the same place at the same time with the same interpretation of what we all mean, which is incredibly difficult. So I think if I consider progress to date it also ironically makes it quite challenging to talk about progress to date in the loan market, because we only know about transactions when banks and borrowers look to make them public. So there may be any number of transactions of loans that have been written on a SONIA basis that institutions are just not making noise about, not promoting, and so we just don't know. But I guess it is fair to say that I think the first SONIA loan was written in around about June, July last year. Since then, I'd be surprised if we're talking much beyond a double-figure number of loans out there in the market. And this is one of the key questions that the Bank of England has recognised, the FCA has recognised, to say, well, what's the problem here? Let's establish this Loan Enablers Task Force to identify what are the blockers to a greater volume and velocity of SONIA or alternative RFR loans in the market, and what do we need to do to overcome them? If I start with the latter point, ironically, the what do we need to do to overcome them is sort of what Edwin alluded to, where we put out a roadmap to achieve each of the interim milestones and then demonstrate a direction of travel towards kind of complete cessation of LIBOR by the end of 2021. As it turns out, I think I'll get a little bit hazy on the dates, but I think that was published in sort of the second week of March, and then the real consequences and impact of COVID-19 became apparent sort of almost as soon as the ink was dry. So one of the things the LETF is now going to go and do is sort of replot that and replan that, and we've worked with the regulator to refine some of these interim steps and measures, and one of the things that we will then do is help the market with a kind of route map of things they need to be thinking about, things that they should aspire to achieve by certain dates in order to sort of serenely glide over the finish line rather than arrive there in a big old puff of smoke and chaos. It's probably a fairly apt description for my house at the moment for anybody who can hear what's going on outside. But if I get into the blockers element, so what's stopping people, it essentially boils down to, in my view, I'd probably get that down to three things. One is consistency and clarity around the method of calculations. We call that conventions for shorthand, and I don't propose to get into that here in any real depth, but I'm very happy, as I'm sure others are, to talk about that at a later date. But essentially, given the same set of inputs and parameters, would everybody arrive at exactly the same outcome? Would they do the calculation in the same way? is a question that has been out there. So we need to understand the way in which we will do that. And we have, I think it's fair to say that the approach we've taken in the UK is to look to those more mature markets, and we've looked at what the FRN market has done. We've looked at the ISDA protocols, and certainly those transactions that NatWest has written in the cash market space have lent heavily on essentially what was the kind of the best information that everybody had at the time. What's happening now is we're starting to look over into the US market and be a bit more focused on cross-currency alignment, and we are recognizing that in those two markets there is a degree of divergence, and the aim of the game now is to, in short order, sort of bridge that gap so that we can have that consistency. Which then leads on to my second point, which is one of confidence. On both the sort of sell side and the buy side, to branch out and do something on a bilateral basis, blinkers on, and sort of back your own judgment and assessment, if you like, that's the right outcome and the right answer, takes a strong degree of bravery. And the markets are notoriously sort of herd-like in their mentality. So to break away from that and write the first loan or the second loan or the third loan takes a bit of a leap of faith. The third element then is the pool of, I guess, the knowledge of how to do that and the experience that people have of doing that is just at this stage very, very limited. So there are a handful of banks that have done this. There's a much smaller number of borrowers that have done this, and on and on and on. There are only a handful of law firms that have seen the documentation and know what the contracts look like and that sort of thing. So the cash market has been slower to materialize. It's not for want of trying, and I think some really interesting developments that we've seen within the last 3 to 6 months have been around some heavily largely syndicated multi-currency facilities that have operated on the basis that Edwin has sort of alluded to earlier, where you enter into that on a LIBOR basis on day one, but you understand that on a predetermined date that will become a fully fledged, fully operating SONIA or alternative facility. And that's been a my personal view is that the way that the market develops and the understanding and the knowledge develops in this space is exactly through that. And we move away from some of the theoretical and into the practical. And you've got a term sheet in front of you. You've got a borrower that wants to achieve a certain thing, and you've got 10, 20, 30 banks that are all motivated to meet that need. So we have this feature in the market today which sees that kind of switch mechanic relatively well understood, but again relatively well understood on the lender's side, but only implemented or executed by a very, very small number of borrowers. So I think as we look at the revised Q3 target, that element of awareness and education and understanding and bringing both sides, both sell and buy side, along together is probably what I think we would need to focus on. I could talk and talk, but I will seek not to. Are there any questions, or is there anything on that you'd like me to expand?
So many questions. I think the one specific question I'll ask right now that's come in is to do with alternate reference rates. So far today, we've spoken a lot about transition to SONIA, particularly in the loans market. Jamie, is there a reason? Is there much appetite? Is there a good reason, a bad reason to look at alternate reference rates? So perhaps referencing Bank of England rate or different rates when you're looking at borrowings in particular.
Yeah. So on a I guess on a holistic level, one of what I think that this whole transition opportunity affords banks is the chance to take a proper look at their full product set. What am I offering to whom? Why am I offering it? Do I need to offer these 5 or 6 products, or can that client need be met much more simply? You know, on all sides of that story, everybody is looking for simplicity, efficiency. There's a I think a sentiment that in certain areas people have become a little bit overcomplicated, if you like, and try to be all things to all people, and you know, therein an element of indigestion lies. So yes, I guess as I look at and it's an approach we've already taken within NatWest, we've taken the view that for a certain type of borrowing need and certain type of customer base, that customer need can be met through a base rate linked facility. So we have stopped writing LIBOR business in a certain sector of the market and replaced that with base rate. I think that's an entirely, I would expect other institutions to be doing the same and to see that continue. Similarly with you know, bluntly taking all of this calculation and reference rate sort of architecture off the table and writing a fixed rate product, I'd expect a greater demand for that. Conversely, in the current interest rate environment and the view that people are taking, I think a fixed rate is probably something that folks will move to as and when they see, you know, central rates rising again. It's not a product that's got an awful lot of attraction in a low rate environment outside a specific kind of set of needs. But so yes is the really short answer. The slightly longer answer is that when you get into a syndicated market and you need a depth of liquidity within that market and people all to be operating on the same basis, for whatever reason, historically, today that is a LIBOR market. So you're not seeing, in my view, big syndicated facilities written on base rate, for example. That may be a natural evolution or a natural consequence of what we're all looking at the moment, but that's not been a feature today. So you get back to the sort of, as I say, liquidity element and what is the market doing versus what am I doing, and am I going to be an outlier? Am I going to be able to you know, meet client need in the most appropriate way?
That's really helpful. Thank you very much indeed. And I guess one of the things that's comes up a lot in conversations is to do with infrastructure. And maybe David, you might have a view about where we are in the development of the infrastructure to be able to manage SONIA transactions. There seems to be a bit of a blocker, certainly in the loans market.
Yeah, I think that's a fair observation. And actually, as somebody who spent the best part of 20 years working in structured derivatives, I'm a relatively new to the loans market. So I've had the benefit of seeing certain things with a fresh pair of eyes. My personal view, and based on my own experience, is that I think, you know, the derivatives world historically has probably been a place, certainly in the institutions that I've worked in, that have received a significant amount of investment in infrastructure, and therefore, whilst it's not trivial to move through this transition from an infrastructure perspective, I think it's fair to say that a lot of dealers have a lot of very highly skilled quant analytics teams and risk infrastructure that lends itself quite nicely to transition or modification. Even though that's still a wholesale change, so I don't want to understate that. I think Jamie has already and correctly alluded to the fact that the cash market and the loan market in especially is just that much more fragmented, both from an operational perspective, but lacks some of the commoditization, even when it comes down to documentation. We've already talked about that, which just means there are just more things to consider. So I won't make any further comments on the specifics of derivatives infrastructure. I think it's fair to say it's just further ahead. But again, that's not to say that that counterparties and all market participants don't need to fully understand and assess all of the impacts of moving, because it has other consequential impacts, and maybe we'll come on to this in a few minutes. Not just infrastructure, but one needs to consider how risk and financing, hedge accounting is going to work. And we haven't even talked about tax yet here today. But there are all of these second and third order effects. But just back to infrastructure for a second. I think again my view and opinion. I actually think I think this is a really fantastic opportunity in the loans market for the industry to assess the platforms and the infrastructure that it's using. I mean, as you already said, I think, Sarah, that LIBOR, or was it Edwin? I forget. LIBOR was created ultimately for the lending market, and so therefore has been embedded in it for the longest period of time. And so therefore, in my view, it's only to be expected that it's going to take that much longer to unpick some of the infrastructure. So there are challenges, and the Loan Enablement Task Force, I think, has proved itself to be a good forum for assessing those issues and trying to move the gating items along.
That's helpful. Thank you very much. Olivier, is there anything that you would like to add when we're talking about systems or infrastructure, or basically the plumbing that's going on behind this transition, and the extent to which the markets that you're active in are ready? Want a better word?
Yes, well, they are ready for most of them. I think there are some technical details which are the consequence of these new rates. These new rates, as Edwin mentioned, they are actually capturing a wider space of data before getting it published. Okay, so for example, it's all secured, unsecured overnight lending into large financial institutions. To gather all that amount of data for one day needs actually these indices to be published the next day. And that's a setback for, a price to pay for comprehensive data is the fact that the data are slightly late compared with, for example, a LIBOR, which is available immediately on the same day. And I'm saying this as a detail because this has actually been the backbone of most of the issues into market infrastructure in issuing new, for example, ESTA, index-linked securities, to have a proper reflection of when to pay an interest, etc., etc. So you have details like these that actually still work in progress in order to have a fully developed and automatized and I would say industrial market into these securities linked to FRRs.
That's helpful. Thank you, Olivier. Right, in the interest of time, because although I thought initially that an hour and a half sounded like a long time, I suspect the four of you we could talk all morning. Can we talk a little bit about the announcement that came out at the end of April that said that the transition for loans would be slightly delayed? And I think, Edwin, you mentioned this earlier. One of the questions that's come in is that although the data has been relaxed to the end of Q1 2021, if a borrower and a lender are both ready to borrow under SONIA, they're just checking that would be okay for them to do.
Yeah, well, maybe I could come in first, Sarah, and say, of course, not only okay, but positively encouraged.
I thought you'd be happy.
Yeah, I mean, I think the reality is that those borrowers who were amongst the the first, let's say it was less than 100 of them, but those who were among the first to move to SONIA facilities, either in terms of their new lending or converting some of their existing facilities, those guys are going to be feeling pretty happy about the decision that they made, given what has happened over the past couple of months and the way that SONIA has behaved compared with LIBOR. And I think there's a very strong encouragement from the working group and from the authorities for others to take advantage of the programs that all the main UK lenders now have in terms of pilot SONIA lending programs. Now, those may not be available in scale across the entire market until a little bit later this year. But I think I'm right that all the main lenders have already got at least some customers using the new reference rates. I was going to make one other point, which is one other market we haven't referred to here, but it's another lending market where transition is also, in fact, in the UK at least, substantially complete, is the mortgage market. Now, there wasn't a great deal of LIBOR referencing mortgage lending, but there were still at the beginning of this journey in mid-2017, there were still a number of mortgage lenders still using LIBOR referencing mortgages, and that has effectively stopped. I think that the last one was going to finish in time for the Q3 target this year. And in that market, obviously, products based on bank rate, sometimes called base rate, but the Bank of England's policy rate, are already commonplace and widely used. And I think that, as Jamie was saying, products like that are also already in quite wide use across some of the smaller corporate borrowing community in particular. But our sense from the discussions that we have in the working group and with others, and Sarah, you've been a part of those, is that as you go up the scale in terms of the sophistication of the corporate treasury operations, they're more and more likely to want to use SONIA referencing products, because of course those are going to be the ones that are most easily and perfectly hedged with derivatives and are most going to match most closely the other types of products that are in somewhere else on the corporate balance sheet. So I think for people to move ahead of the rest of the crowd towards those is a great idea. You can have the confidence that in the end everyone else is going to follow. And conversely, if there's a kind of takeaway from this call, it would be we're very keen that nobody doesn't take the opportunity to be ready for that change over the next few months, because this change is going to happen. And if there are people who have not prepared for the new centre of gravity in interest rate markets being SONIA and LIBOR disappearing, then obviously those firms are going to face a range of different problems when LIBOR comes to an end, whether that's in terms of systems or in terms of renegotiating outstanding contracts or the legal risk as those contracts are frustrated. So getting ahead of the curve, really smart idea.
Thank you. And as I've got you on screen, so to speak, Edwin, several more questions come in for you. But one question that's probably interesting to answer is about international alignment. And I guess people are looking for a little bit more colour about how that's working and if they can be involved in it. I think for a large number of people that are listening this morning, they have dollar debt in some form or another, and so clearly what's happening in the US markets, or the perception is what's not happening, or the noise that's coming out of the US markets, is particularly interesting to people. So I don't know if you're in a position to be able to say a couple of words about how we're all working together to haul ourselves over the line, or not, as the case may be.
Yeah, well, look, we are all working together, and US authorities are absolutely as resolute as we are that this is a transition that needs to happen, because LIBOR is no longer a suitable foundation for financial markets. given the way that those markets have themselves changed. So if we had Fed colleagues on the call, they would be impressing just as strongly on the need to ensure that all corporate borrowers can continue to finance their operations using reference rates other than LIBOR going forward. Now, of course, some of that coordination is going to be very visible to me and not necessarily visible to corporate treasurers, although others on the panel here will know about some of the international liaison that's happened on the loan side in particular. Jamie talked a little bit about the opportunity to harmonise some conventions. It's true that on the lender side in particular, that some of the main system providers, the vendors of systems, are the same companies who do most of the business in the UK and in the US and Switzerland and so on. So there's a very, very powerful case for alignment there. I have to say I'm less close personally to who the main providers are in terms of treasury management systems, but I do know that other colleagues on the risk-free rate working group have convened all those TMS providers. So if you're a corporate and you've got a TMS provider out there, they will know about this LIBOR transition too. They will have heard from the authorities directly on the importance of being able to move. And I would hope they would be preparing with determination to be able to serve their corporate clients' needs in this space.
Thank you, that's really helpful. Another series of questions have come in relating to timelines, not surprisingly. Suddenly everybody's getting very focused on the fact that the end of 2021 is closer than you'd like, particularly given the distractions that are going on at the moment. I'm not sure that this is a question particularly for you, Edwin, but you're welcome to go first if you like. There is a nervousness about what will happen if for some reason people haven't been able to, for example, transition some of the legacy deals to SONIA or an alternate reference rate by the end of 2021. Has any thought been given to sort of that cliff edge risk?
Yeah, so this is a really important question, and it's probably useful to think about new business and legacy business in slightly different ways. So for new business, clearly people need to be ready to do that without LIBOR from the end of 2021 and hopefully from somewhat before then. For legacy business, there's a different set of challenges. Sometimes it will be possible to convert some, and practicable to convert some of that outstanding stock of legacy instruments. And indeed, you can see some of that happening. So the bond conversions that I mentioned earlier, there has been some publicity about some loan conversions too, although as Jamie was saying, there may be others that there's simply been no publicity around. But one strand of the risk-free rate working group's work has been on something that we've labelled tough legacy. So those contracts where perhaps it's not going to be feasible or practicable to convert them before the end of 2021. And I think that's a particularly knotty problem. Often members of the working group say, well, can't you in the authorities, and particularly you in government, can't you legislate to take this problem away? And some people on the call will be aware of a proposal of that shape, which has been put to the New York State legislature to provide a sort of safe harbor for retrospective or let me word this carefully, to give the payer of the interest rate safe harbor from legal disputes if they take a particular solution towards continuing that LIBOR referencing contract after the end of LIBOR. Now that is an issue that we're going to have to discuss further in the working group and indeed with the government here. But I think the really important point to leave participants on this call with is that if you want to have control over what your interest rate obligations and entitlements are going to be going forward, then waiting for legislative relief is not the solution. So one thing that is very clear is that different markets are probably going to prefer different solutions to life after LIBOR. So in derivatives and bonds, as we've talked about, everyone is going to coalesce around overnight rates compounded in arrears at the end of the period. Now, at the larger end of the loan market, I'm sure we'll see the same. But at the smaller end of the loan market, less sophisticated borrowers, there is certainly a subset of those who prefer to know what their interest payments are going to be in advance. And that's something that a 3-month forward-looking rate can provide. Now, legislation that turns LIBOR into X plus Y, where X is some new interest rate benchmark and Y is the credit spread, or at least a fair representation of what the credit spread would have been, then there can only be one X, and of course only one Y. And the different markets might want a different X. Some are going to want a backward-looking one calculated at the end of the period. Some are going to want a forward-looking one. So don't wait for legislation. If you can convert your legacy stock, do. That's the only way in which you are going to have full control and remove any uncertainty on what might happen to those legacy contracts.
Thank you, Edwin. I think it's very clear. And following on from that, one of the questions that's come through relates to the credit spread adjustment that Edwin's just alluded to. I really don't know who wants to take this, but is there going to be a market consensus as to how the credit spread adjustment is calculated, applied?
Why don't I do that one too?
Okay, fine. Fabulous.
This is a nice one to jump in on, because the answer to that is that there already is a market consensus on how it should be calculated. So some years ago, we on the authorities side, and by that we I mean the international authorities, so that our US, Japanese and other colleagues, asked ISDA to lead this particular piece of work on how you would calculate a fair credit spread to capture the difference between LIBOR, which has a credit element, and the risk-free rates, which don't. And in a series of consultations over the past years, David referred to some of these, a very strong consensus has emerged across the market. And the reason, of course, we asked ISDA to do this was because that is a body which we think very evenly captures the interests of payers and receivers of interest rates. So we think that was a group that was likely to come up with a really balanced solution, which could attract consensus, and that's what we found. And I don't want to go too much on the technicalities of that, but the model on which people have alighted is essentially taking a 5-year backward-looking median of the difference between LIBOR at the relevant tenor and the relevant risk-free rate. So that's for the derivatives world. Obviously, then there's a question about, and that is what will be embedded in the fallbacks in derivative contracts, both for new ones and for those who very sensibly sign the protocol for their outstanding derivatives, to avoid the do nothing kind of nightmare scenario that David alluded to earlier. That will be in derivatives. The risk-free rate working group also did a consultation on what would be an appropriate credit spread calculation for cash markets. And I think very sensibly and understandably, the results that come back in for that, they're published on the Bank of England's website, were again a consensus that cash markets should use the same solution as derivative markets. So we have out there something that has market consensus. From the FCA's point of view, those that use that market consensus as part of their conversion of legacy contracts, that for us meets the requirement of treating customers fairly.
Thank you. I think that's very clear, and it's great to hear it from you as well, Edwin. Thank you. So plowing through a few more of the questions, there are many questions coming in, and I apologise in advance that we will not get to nearly any of these, all of these. I think this is a question for you though, Jamie, although David or Olivier, please feel free to jump in. If there's no specific fallback clause in very old loan agreements, what happens? And go.
Yeah, indeed.
Yeah.
So, you know, I guess fallbacks is one aspect that we've not really touched upon in this discussion, and we probably should cover. So I guess, so to take the specific question, in a scenario where there is no fallback, quite simply, there is nothing then that governs the way in which your loan will operate and function. So in that scenario, it is in everybody's interests to kind of get together and understand what's happening, what their positions are, and kind of work out a position that works. In practice, that's probably about as much fun as I've made it sound. So I think that's entirely a scenario that both sides are motivated to avoid. One of the ways that we avoid that, I guess, obviously, is by a very proactive stance on transition, proactive on both sides. So both sides recognizing that is a situation that they simply do not want to be in, and implementing a more survivable contract that is then based on SONIA. What you find otherwise is historically in the loan market, fallbacks are now having their moment under the sun. I think it's fair to say there's probably an element of the contract that has not seen an awful lot of evolution or development, even since the financial crisis. But boy, are we all talking about it right now. Fallbacks are designed to deal with a kind of momentary, temporary unavailability of LIBOR, or the reference rate, which is to say, you know, we need to determine our interest repayment. Oh, LIBOR's not there. Where do I go? What do I choose, and how do I do this? And there are a number of differing ways of doing that. Usually some form of waterfall where you can go and look at yesterday's LIBOR or previous LIBOR, or you can go all the way down into the sort of depths of cost of funds, or what people's LIBOR submissions are, and all of that sort of stuff. Even and I think this is a point that I would expect Edwin to sort of reinforce quite vigorously. A fallback, even a fallback that explains to you how you navigate your way through a scenario where LIBOR doesn't exist, that is not sufficient as anything that you rely on or depend upon to give you confidence and comfort that when LIBOR ceases, that you're not going to be in a scenario where you need to still get yourself into a contract that is survivable and operable on a longer term basis. So one of the things that I think people will be seeing in the market over the last 6 months or so is that as we navigate this period where we're still developing SONIA product set, and we're still, there's still a limited amount of demand for that, and lenders are sort of meeting demand through a LIBOR product set. You will see that your fallback language has become clearer. But again, the very scenario of being in a fallback is not is not a good place to be, and B is not a set of circumstances that contemplates LIBOR never coming back again. It is to deal with a moment in time, temporary unavailability of the reference rate. I'm trying to think whether I've answered the question. If there's no fallback language,
I was just going to add one. Sorry, yeah, David. I was going to add. I think one thing to add. You've hit the nail on the head here, and to turn this back into a matter of practice in lending markets. I think it's prudent to assume, for the reasons you set out, that one does not have adequate fallbacks. Not least because to rely on the fallback concentrates the transition effort for loan lenders and borrowers all towards the end of December next year, which feels like a Y2K event on steroids to me, and one which we all should try and avoid. So, my point being, assume that there are no adequate fallbacks, even if there are, and seize the time between now and then to refinance and/or amend your existing agreements to be compliant with the way the market is going to operate in the future. And I think that's a very important takeaway for the audience today.
And I think that's exactly what the kind of, for those that are as familiar with it as I am, the second bullet point of the announcement from the RFR working group explicitly deals with it. It requests contractual mechanics to convert a facility onto a fully functioning, fully fledged, survivable SONIA facility at a given date in time. That is a world away from an adequate fallback. So I think that's what people should focus. I think that's the intended message around the revised Q3 target and what we want people to focus on, which is that there are different ways of proactively approaching the situation when it is everybody should be universally aligned in looking to avoid waking up on the 1st of January 2022 and finding that they've got a set of products, instruments, contracts that they just don't know how to operate anymore.
That's really helpful. Thank you very much indeed. I realise that we're getting towards the end of our allotted time. So just one final question to wrap up, and I apologise that we haven't covered probably half the things that we could have done, but that's the way of things. Gentlemen, if there's just one thing that you'd like treasurers to be doing, asking, thinking about between, let's say, now and the end of the year, realistically, what would that be? Olivier, would you like to go first?
Sure. I think the conversation we just had shows that we need to be prepared, and not to be prepared now, but just ahead. And one thing that I would add on the discussion that was held is just price your loans, price your investments. I take the existing documentations and play with around different scenarios of what ifs, and it will help you. And that's our target in the asset management world, in securities which are sometimes difficult to transition, like Eurobonds. Just try to ascertain where is your risk in terms of the dark scenario, the rosy scenario, and go into negotiations with that in mind. And the second thing that I would say is, for those who are not used or familiar with these rates, I think play around with these rates. They are actually far easier in terms of financial methodology than LIBOR. They are cleaner, so it's actually a very good way to enter into that transition, is to get used to those new risk-free rates, and not only in the large countries, but also maybe sometimes in the more remote country we haven't talked about.
Olivier, that's really helpful. Thank you very much. David, would you like to come up with your just one thing?
Thank you. I'd say produce an inventory of all of your relevant systems that may be affected when LIBOR is no longer published in the future, and consider what changes you need to make. In doing so, you will, as a byproduct, understand what all your exposures are. And you may not have all of the answers from that, but I think that's a significant step in the right direction. And then next step after that is establish direct contact, if you haven't done already, with your market counterparties. Call up your banker and say, look, I've identified my exposures. I'd like to talk about how this is going to happen over the course of the next 18 months. And put the theory that we've talked about today really into practice. Now is the time for action.
Great. Now is the time for action. Jamie.
It's always good going third, isn't it? I think for me, it's probably a mindset and an approach thing. Approach this proactively and collegiately. This is not a bank problem where banks will define and drive the solution and then present it to you, and that will be that will be the way that it works. This is something that we collectively, both sides of the equation, need to work on together with the same degree of motivation and intensity in order to meet these milestones, to give ourselves, give the market confidence that we're on the right path for transition, and to sort of survive this pretty seismic market event together. There will inevitably be a degree of friction, but on small areas. But for me, please don't assume that your bankers or your lenders know all of the answers, have got so much more knowledge or understanding than you do, and will just come and just wait for them to come and tell you what they think you should be doing. This is something that everybody needs to demonstrate ownership of, and work together on. So that would be my kind of message to leave with the audience.
Thank you. And last word to Edwin, perhaps.
So thank you. And what I'm going to say is going to build on what David and Jamie and Olivier have already said. But firstly, make sure that you can run every element of your business going forward without LIBOR. So whether that's borrowing, whether that's your derivatives hedging, whether that's your treasury management systems. And when you've done that stock take of what your sort of legacy LIBOR exposures look like, again, across all those different products potentially, then come up with a plan that makes sure that all of those are robust to the discontinuation of LIBOR. And often the best answer will be converting those before the end of 2021. Your counterparties will also have an interest in doing that. Sometimes it might be relying on a fallback, signing the ISDA protocol or similar, but don't be left there without a plan on New Year's Eve 2021. That's not going to be a good New Year's celebration if that's where you're at.
Not least because it's my birthday, New Year's Day. Anyway, thank you very much indeed for that, Edwin. We've reached the end of our time. In fact, we've slightly overrun. Apologies. Thank you all very much indeed for the questions. We haven't been able to address all of them, but we will, over the course of time, try to pick up as many of those and comment on them offline. Personally, I think that this session has provided a very efficient way to get up to speed with the latest developments, and it's been recorded, so you can reference it again. And anybody who registers for the International Treasury Week before the end of tomorrow will also have access to this recording. A quick nod to the ACT. There's a checklist for treasurers that we've authored, which is on our website, may also be useful. Next to the Q&A button, you'll see a feedback button. Please take the time to fill in the survey. The feedback you provide is very helpful to us when arranging future events. Also, there's a growing library of pre-recorded sessions which are available to watch now on both technical and softer skills. Finally, thank you to Edwin, Jamie, Olivier, and David. Goodbye.
Thank you.